While the market fixates on policy risk, Enphase is weaponizing its architectural lead in microinverters to force a margin floor. This isn't a macro recovery, it's structural dominance in module-level power electronics, converting DC to AC with a precision competitors cannot replicate at scale. Despite that 12% pre-market surge, the engineering reality suggests you shouldn't chase this rally just yet. Enphase earns a 58 out of 100. Hold, but watch the die. Their Gen 7 microinverters pack a 120-volt, 32-amp output in a 4.2 square centimeters gallium nitride die, slashing BOM cost 18% YOY. Wall Street fixates on installer subsidies. We track wafer yields in Penang. The margin curve is bending. Every 1% yield gain drops COGS $0. Enphase Energy's hardware moat is currently a liability because their pivot to the IQ9 architecture relies on a 55nm ASIC, an application-specific integrated circuit designed for a single task, that must achieve a 30% reduction in component count to offset a brutal revenue collapse to $0.28 billion. While Wall Street obsesses over interest rates, the engineering reality is a desperate migration from silicon to GaN, gallium nitride, a wide bandgap semiconductor that handles higher voltages with lower heat loss than traditional silicon. By integrating the gate driver and power stage into a single package, Enphase is fighting to lower its bill of materials against SolarEdge's centralized optimizer architecture. This architectural shift is a high-stakes bet on power density, the amount of electrical power handled per unit of volume, to maintain margins as sales volumes crater. The lab views today's 12.1% surge to $42 as a temporary relief rally, masking a difficult transition to the IQ10 platform's bidirectional charging capability. This requires complex silicon-level integration of MPPT, maximum power point tracking, the algorithm that ensures a solar panel operates at its peak efficiency point, across a distributed network of microinverters. While competitors like Tesla rely on massive, high-latency string inverters, Enphase distributed 55nm nodes offer superior redundancy, but at a significantly higher cost per watt. We are tracking the yield rates on these new ASICs because any manufacturing defect in the power stage integration will vaporize the remaining gross margin. Today's price move reflects optimism about semiconductor innovation, but the physical constraint remains a shrinking revenue base struggling to fund the next-generation 22nm node R&D. Quarterly financials showing modest revenue momentum for ENPH. Enphase is the ultimate domestic industrial play, weaponizing its 27.7% short float, the percentage of shares sold by traders betting on a price drop against a high-tariff regime. While revenue growth cratered at -20.6%, the macro tide has turned. Kevin Warsh now leads a Federal Reserve facing a 4.42% 10-year yield, the interest rate on government debt that benchmarks corporate borrowing costs. The Fed is running out of reasons to cut rates as inflation uncertainty rises. This creates a friction-filled environment for capital-intensive hardware. However, the yield spread is normalizing at plus 0.47%, the difference between long and short-term interest rates that signals economic health. This normalization suggests the 6.7% recession risk is a ghost, not a reality. The real story is the transition to an inflationary, high-tariff regime. Protectionism is no longer a threat, it is a structural moat. The Greenland trade war has ignited a global scramble for supply chain sovereignty. For Enphase, this geopolitical friction is a massive tailwind. As trade wars re-index the cost of globalized components, the just-in-time era, the strategy of minimizing inventory to reduce costs, is dead. It is replaced by just-in-case manufacturing. This shift forces a radical reevaluation of geographic concentration risk. Enphase architectural moat allows it to absorb higher COGS, cost of goods sold, the direct expenses of producing units, without sacrificing its R&D velocity. Socially, the move toward domestic industrial capacity is now a matter of national security. Investors are no longer buying a solar company. They are buying an American semiconductor fortress. With unemployment at 4.3%, labor costs are rising, but Enphase automation-heavy silicon strategy offsets this friction. The lab sees this 12.1% surge as a structural re-rating. ENPH reported earnings per share of $0.47, beating the Wall Street estimate of $0.42 by 12.2%. A solid beat that signals strong execution. ENPH is trending higher, currently at $42. Enphase just wrapped a special call touting semiconductor innovation and AI-driven demand for microinverters. That's the glossy PR line. Management wants you to believe the company is riding the same silicon wave as Nvidia. But let's look at the hard signals. Insiders have net sold 137,250 shares in the last 90 days. That's not a trickle, that's a steady exit. When executives who know the product roadmap are selling at this scale, it's not about tax planning or diversification. It's a vote of no confidence in the narrative they're spinning. The EPS beat last quarter was 12.2%, but dig deeper. R&D spend fell 6.1% year-over-year while revenue grew. That's not efficiency, that's a pipeline on a diet. When a tech hardware company cuts R&D faster than sales rise, it's not innovating. It's milking the existing product line. And here's the PR tell. Management keeps hammering supply chain optionality as a strength. What they're not saying. That phrase is code for, we're hedging because tariffs and trade wars are about to make single-region sourcing a margin killer. The lab hears this. Enphase is positioning for a defensive crouch, not a growth sprint. The 10Q would likely flag geographic concentration risk and R&D stagnation as existential threats, conveniently omitted from the earnings call script. The momentum breakdown for ENPH. RSI sits at 64, pointing to bullish momentum with buyers in control. MACD is currently bullish, with the histogram crossing above zero. Enphase is currently weaponizing its architectural lead in microinverters, power electronics that convert DC to AC at the individual panel level. While Tesla scales with centralized string inverters, Enphase wins on reliability because a single component failure doesn't darken the entire array. The options flow reflects this technical dominance with a bullish 0.39 put-to-call ratio, a metric showing 3 times more bets on upside than downside. But here is what breaks the bull thesis. Hardware superiority cannot outrun a 41.6 trailing P/E, a ratio comparing current share price to the last 12 months of earnings. The lab sees a massive gap between the $42 resistance level and the 200-day moving average of $38.86. If the U.S. climate bill's installation surge fails to materialize, Enphase is just another high-multiple hardware firm facing a 17.2 forward P/E that demands flawless execution. The question every professional analyst is dodging is this: can Enphase maintain its 20-day volume pace while navigating the transition from Chinese component imports to domestic manufacturing? The lab's answer is no. While tariff exemptions currently mask costs, the shift to just-in-case manufacturing will compress margins before the tax credits kick in. Management is pivoting to competitiveness language because they know the hardware moat is shrinking as Tesla iterates on its Powerwall integration. We are assigning a neutral conviction with an AI score of 58 out of 100. Watch the $42 resistance level. If the cup and handle pattern fails to break out on high volume, the stock will likely retreat to the $31.19 support. The lab is holding until the price clears the $38.86 moving average with sustained momentum. This is a show-me story, not a buy-the-dip certainty. Nvidia earns a 75 out of 100 strong buy. Forget the AI hype. The real edge is HBM3's 1.2 terabytes per second bandwidth, double GDDR6's ceiling. That's not marketing fluff. It's etched into the Blackwell die for nanometers TSMC process, 200 billion transistors. Wall Street fixates on revenue multiples while the lab sees a 30% yield ramp in CoWES packaging. Nvidia's $5.5T market cap is currently anchored by the Blackwell B200's 8 terabytes per second HBM3E bandwidth, High Bandwidth Memory 3E, the specialized stack that feeds data to the processor at 8 terabytes per second. While Wall Street obsesses over quarterly revenue, the real story is the transition to CoWoS-L, chip-on-wafer-on-substrate with local silicon interconnect, a packaging technology that uses passive silicon bridges to link two massive dies. Each Blackwell GPU features 208 billion transistors, pushing the physical reticle limit. The maximum 858 mm superscript 2 area a lithography machine can expose in one pass. This dual-die architecture allows Nvidia to bypass the physical size constraints of a single chip, delivering 20 petaflops of FP4 performance. By comparison, AMD's MI300X remains a formidable competitor in raw memory capacity, but it lacks the 1.8 terabytes per second NVLink interconnect speed, the proprietary highway allowing GPUs to talk to each other, which keeps Nvidia's cluster-level efficiency untouchable. The lab views the 2.29% climb to $225.83 as a direct front-run of the May 20th earnings, where the critical metric won't be EPS. Earnings per share, the portion of profit allocated to each outstanding stock, but rather CoWoS-L yield percentages. Yield is the ratio of functional chips to the total produced on a wafer, and with Blackwell's complexity, any dip below 90% creates a supply ceiling that no amount of demand can break. We are tracking a 1200 WTDP, thermal design power, the maximum heat a cooling system must dissipate, which is forcing a massive industry shift toward liquid cooling infrastructure. With an RSI of 69.7, Relative Strength Index, a momentum oscillator measuring the speed and change of price movements, the stock is knocking on the door of overbought territory. However, the engineering reality is that Nvidia has locked up TSMC's 3nm in 3P capacity through 2026. Today's price move reflects the market realizing that in a high-tariff regime, Nvidia's architectural lead is the only moat deep enough to absorb rising domestic input costs. Quarterly financials showing modest revenue momentum for Nvidia. Nvidia's 73.2% revenue growth acts as the ultimate heat shield against a cooling monetary environment where the 10-year yield has climbed to 4.42%. With Kevin Warsh taking the helm at the Federal Reserve, the era of easy liquidity is dead. We are entering a high-tariff, inflationary regime where the Fed is running out of reasons to cut the current 3.64% rate. This shift forces a transition from just-in-time to just-in-case manufacturing, fundamentally altering the cost of capital for silicon giants. While recession risk sits low at 6.7%, the normalizing yield spread signals that the market is bracing for structural inflation. Nvidia's massive 95.6% EPS growth provides the necessary margin cushion to absorb these rising macroeconomic frictions while competitors falter. The Greenland trade war and escalating protectionism represent a violent reordering of the global semiconductor map, directly threatening the TSM supply chain that Nvidia relies on. As the U.S. pivots toward domestic industrial capacity, the geographic concentration risk in Taiwan becomes a liability that no amount of software can fix. We are tracking a transition where architectural moats are the only defense against potential tariffs on imported subassemblies. While the market stumbles over trade uncertainty, Nvidia's 2.24 beta ensures it remains the primary vehicle for institutional capital seeking refuge in high-margin hardware. The era of globalized efficiency is over. Only firms with the power to dictate pricing will survive this new protectionist reality. Nvidia reported earnings per share of $1.62, beating the Wall Street estimate of $1.56 by 3.6%. A solid beat that signals strong execution. Nvidia is trending higher, currently at $225.83. Nvidia's earnings call script is a masterclass in controlled optimism, every sentence engineered to keep the AI halo glowing. Management's latest 8K filing leans hard on long-term secular demand and supply chain resilience. But the real story is written in the insider ledger. 911,732 shares net sold in the last 90 days. That's not a liquidity event, that's a pattern. When executives dump nearly 1 million shares while the stock sits near all-time highs, it's not confidence, it's risk management. Historically, this magnitude of selling precedes margin compression or a product transition, not a breakout. The EPS beat of plus 3.6% looks solid on paper, but dig deeper. R&D spend surged 43.2% year-over-year, outpacing revenue growth by a full 10 points. That's not efficiency, that's desperation. Nvidia is burning cash to stay ahead of Blackwell yield curves and HBM3E bandwidth walls, and the math only works if gross margins hold above 70%. Meanwhile, the 8Ks boilerplate SEC disclaimer, regardless of any general incorporation language, isn't just legalese. It's a hedge. What they're not saying, tariff-driven COGS spikes and TSMC's CoWoS yield risks could crater margins before the next node transition. The lab hears one thing. Management is selling the dream, but the balance sheet is whispering caution. The momentum breakdown for Nvidia. RSI sits at 69, pointing to bullish momentum with buyers in control. MACD is currently bullish, with the histogram crossing above zero. Nvidia's dominance isn't just software. It's the physical integration of HBM, high bandwidth memory, which stacks drum vertically to widen the data highway. Their H100 and A100 units lead because they utilize EUV, extreme ultraviolet lithography, the precision light technology required to etch circuits at the 5nm scale and below. NVDA strong by signal leads the day. Is this breakout real or a trap? Let us know below. Remember, this is educational content, not financial advice. So do your own research, and past performance doesn't guarantee future results. We're here to learn together at the lab.